Today's topic is liquidity within investments. Liquidity refers to an asset that has a ready and waiting market on both the buy and sell side of the equation. If you're selling a security and there is liquidity, then you're most likely to find a buyer willing to pay you a fair price for your investment. This, at the end of the day, means that you won't be stuck holding an investment when you need cash. And for the lack of liquidity, to compensate for the lack of liquidity, investors often demand a higher rate of return on money invested. That is, investments that can't easily be sold, in most cases, will demand a higher rate of return relative to a similar investment in a highly liquid market. Therefore, quality investments with lots of liquidity typically won't pay the highest rate of returns and will cost more. Let's look at history for an example. In the Great Recession, one of the reasons for so many losses suffered by financial firms was the fact that these companies owned illiquid securities tied directly to the housing market. When they found themselves without enough cash to pay the swaps on these securities and they wanted to sell these assets, they discovered that the market had dried up, i.e. no liquidity, and as a result, they had to sell at prices they could get on the market, which is pretty much pennies on the dollar. In retirement, you should protect yourself from liquidity risk. Never buy long-term investments that are illiquid unless you can afford to hold them for a really long time or the worst case scenario situation plays out. Obviously, if you might need access to cash in the short term, don't buy an investment that locks you up for 5 years or more. If you're interested in investing in illiquid securities, you got to make sure that you do the research. Look at the company's debt. Look at the plans to refinance that debt. And there's many other things that you have to consider. And you should really work with your financial advisor to understand the risk of the asset specific to you and your cash flow and your liquidity needs. This is very true when it comes to developing a well-built portfolio that will meet your long-term and short-term goals. At Client First Capital, our next decade planning workbook is used to understand the liquidity needs of our clients, and we use it to tailor the portfolio to their needs. If you'd like to go through this exercise, please click the link below. You'll find our landing page for our workbook, which you can download and go through the same exercise to figure out your liquidity needs. As always, if you have questions or comments, please put it in the comments below, and I look forward to talking to you guys soon.